Thank you for joining. Good morning, Richard. Thanks again for joining. Right, so I'm just going to quickly go through this disclosure very, very quickly, and then we will begin and get onto the fun stuff. So this presentation is provided solely as a courtesy to the education of customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. The discussions of a particular market or product should not be construed as an offer to sell or a solicitation of an offer to buy in any financial market whatsoever. This presentation has been prepared without regard to specific investment objectives, financial situation, and needs of any particular recipient, and we do not guarantee or verify the accuracy of the information or commentary provided. Futures, options on Forex, futures, foreign exchange, and other leverage products, they involve significant risk of loss, and they're not suitable for all investors. Remember as well, spot gold and silver contracts, they're not subject to regulation under the US Commodities Exchange Act. Contracts for difference, or CFDs, they are not available for US residents, and none of the services or investments referred to in this presentation or webinar are available to persons residing in any country where the provision of such services or investments would be contrary to local law or regulation. Okay, everybody, thank you so much for joining. Now, just bear with me one moment. I'm just going to end. I'm just going to swap my machines or my charts packages around so that you can see things. So I've had a few days off and I've come back in to the market, and things have changed. Things have changed quite dramatically. Oh, I won't put that there. You know, we've seen Eurodollar back up. I did actually send a note out about this on Wednesday, but Eurodollar, you know, is recovered, so is the pound. The dollar's come under broad-based weakness. We've seen dollar yen fall very, very sharply, and we've also seen the Aussie come under a lot of pressure. So Pan, you're on fire already, right, with the questions. Can we buy the yen now? It's an interesting one. A lot of people are like, well, what is going on? Now, this chart that I'm going to show you now, I'm going to show you the first thing, or the first cross I'm going to show you is not one that, you know, maybe you will trade, or maybe even ones that you will know, but it's Aussie yen. And the reason why is that it's really relevant right now for two reasons. Firstly, the yen is... Pan, sorry, didn't get that joke there, but yes, sorry, very, very long disclaimer, but unfortunately it's, I have to do it, otherwise I won't be able to continue doing these webinars, so thank you. Aussie yen is important now for two reasons. Number one, it's kind of your ultimate risk currency because you have the Aussie at the very risky end of the FX spectrum that kind of moves with stock markets and commodities, etc. And then you have the other end of the spectrum, which is the yen, which is, you know, your safe haven, you know, it should move opposite direction to risk. So that's one reason why this is significant, because we do seem to be in a bit of risk-off mode. Certainly stocks are lower. The second reason, of course, is that we are testing this 200-day moving average on the close. So I know that some of you will look at 200 moving averages, and you'll look at them at different, there are different ones out there. There are some that are, you know, maybe mid-range, high lows, etc. This is the close, and I find that just the easiest. This is the Bloomberg chart, so it's kind of your standard on Bloomberg, and it is just the easiest for me. You know, looking at moving averages based on close prices, purely because you know where you stand. So that's why I find them significant. I also think that a lot of people look at them on the close. So again, technical analysis is all about, you know, what is the crowd doing, and that becomes, you know, that's why it becomes so important, really. So as you can see here, Aussie yen has actually just gone through the 200-day moving average. Now remember, a 200-day moving average, a long-term moving average, is very, very important for this cross. It's always an important support level. So below it is a bearish development. I mean, one thing you would notice, obviously, when you get the you know, we haven't had like a real kind of death cross, so we haven't had, you know, your 50-day cross below your 200-day. That's a very bearish development. But the fact that it breached this support very, very easily, really, that support comes in at 91.75. We've gone all the way down to 91.20, 91.30 right now. Really does open the way to 90. If you can see, I mean, we've had, you know, very long candlesticks over the last week. Blue candles are, you know, down days. And as you can see, some very, very long, long candles. Obviously today we think, you know, we could potentially find a good bit of support around about that 91.20 mark. But overall it's going to be, you know, there's going to be the key driver of this cross is going to be what is Aussie dollar doing, what is dollar yen doing. On that note, let me bring up my other chart quickly. This is dollar yen. This is what dollar yen is doing. Now, this is a weekly chart, so it just shows, you know, potentially how we've made a top just ahead of that 105 level, certainly in the medium term. But let's narrow the time frame a bit. Let's go back to the daily chart. As you can see, still continuing to fall. Now, remember, when you see a long shadow in a candlestick, you've got, or any kind of long shadow, either to the upside or the downside, you've always got to be a bit wary. Always watch it. As you can see here, that happened 2 days ago. Oh, yeah, that happened on Friday. So we saw a sharp drop lower, down below 95, got to 94.75 at one point. That's post the payrolls. But you know, the market didn't like it down there. As you can see, tiny bodies, we had a positive close. So the fact that we had, you know, the long shadows were a lot of selling interest there, but the fact that, you know, the buyers came in immediately and picked it up, it suggests that, you know, there is very good buying interest indeed. But right now the market is still not willing to make up its mind, because these two candlesticks tell the next chapter of that story. So the fact that we've got a bearish engulfing is quite negative, but the one thing we would point out, of course, is that, you know, currently we're trading 97.57. We had a real sharp lurch lower in dollar yen just earlier, which has really impacted a lot of other crosses, and I'll go through there. Some very volatile movements right now in the FX market. We're seeing volatile movements in stock markets as well, but you know, the fact that we've got this bearish engulfing candlestick now suggests that, you know, we could be on the way we could potentially be on the way, you know, we may start to look, you know, oversold right now on dollar yen, because we've had such a sharp move. And indeed, the daily MACD is in very, very bearish territory, which suggests maybe it's just come too fast. Is Abe being hawkish or dovish? I can't figure out his speeches. And it's not just Abe, it's Kuroda as well. I think basically what they're trying to do in Japan is, we had the Bank of, if you don't know, we had the Bank of Japan meeting overnight. They didn't do anything. So what we're seeing instead is some real volatile, choppy moves. Obviously, you know, Pan is right, you know, are they being dovish or hawkish? We don't know. They're kind of saying, I think they're kind of covering themselves, which is always difficult, but obviously they're doing a high risk strategy, Pan, so they need to cover themselves. Otherwise what will happen is, you know, they'll come under a lot of stress themselves, and they'll come up for, you know, they'll be blamed for things. So what they're saying is, actually, you know, what we're doing, we're not going to do any more, because we've already done a huge bond buying spree. But one thing I will tell you, though, is that, you know, we are helping the economy. We are not causing volatility. We'll go tell the FX and the bond market trader that, because I don't think that's the case. So I agree with you very much. I think a lot of the markets are saying, hang on a minute, you know, yes, Japan has enacted this huge stimulus action from both the fiscal side and the monetary side, but then on the other side of things, you've also got, you know, with that comes a lot of responsibility. So we really do need to start seeing you know, we don't expect to get to anything too clear cut when politics are involved. Basically, that's the high and low of it. Let's look at the hourly chart here, just to get some more short-term views on what could happen with dollar yen. Now, this is an interesting chart, really, because it doesn't happen very often. So take a look at it closely. So this is dollar yen. It's an hourly chart. Okay, so just an hourly chart. It goes back to, where does it go back to? Say the end of May. As you can see here, in just like, you know, 10 less than 10 days, what we've seen is a move from 102.50 all the way down to 95.50. That is huge. If you traded that lower, you'd be in good stead. We certainly felt that, you know, around about kind of towards 105 was a low. Picking that bottom was hard. 95.50 was a hard one, but as I told you, you know, that you kind of could only pick it really on Monday. You couldn't, it would have been difficult to try and get there on Friday, but, you know, that candlestick that we saw on Monday, I wasn't in yesterday, but, you know, that was suggests that we've got maybe a bit of a short-term bottom in place there at just below 95. You know, we make a recovery then back to 99. So again, 400, these are big moves, right? That's 400 pips. And then we fall back from there. Now this is the, 200-hour moving average comes in at 99. That suggests, that suggests that, you know, that's going to be good, you know, short-term resistance, right? Because we're seeing these very large moves. On the downside, though, we've obviously got 97, and then we're kind of looking at 96.50. So we're going down kind of in the whole number, in the halves. The round numbers, sorry, I should say. And then obviously you've got 95.50. Now, you know, obviously we've had a sharp move lower already today. That doesn't mean that we couldn't see any sharper moves, because as you can see, we have moving very, very quickly in dollar yen, in all of the yen crosses. So if you are trading yen, dollar yen, it's one hell of a ride. I think that there could potentially be some buying interest. Obviously, the closer we get to that 95.50 level. For those of you who are less, who don't really want to go for that ride, then there'll probably be some buyers around between kind of that 95.50 to 96 level. You know, between now and then it's quite hard. I think sellers are coming in at 99. Right now we don't really have anything, certainly in the next 24 hours. I certainly wouldn't, if you are trading dollar yen, I certainly wouldn't widen your time frames broader than that, or widen them further than that. The reason why is that we've just seen such volatile moves, so that, you know, the next move is kind of anyone's guess. So in this environment, you pick your levels, and we've done that now. 99 on the upside, 95.50 to 96 on the downside. Yes, you know, if you were to buy at 90, if you were to potentially pick it up at 96, yes, it could go down to 95.50. God, it could even go down to below 95. But we think at some point you're going to have to keep your stops wide. But we think that was a false break lower. So that's where we're standing at the moment, is that it's a false break lower. We still tend to think that dollar yen, the bias is higher, even though we do think that gains will be capped. It's a rough ride there, and it's interesting, isn't it? Because, you know, those of you who are regulars, who join this regularly, will know that, you know, this has been, you know, the trade of the year so far. Well, you know, I guess we're 6 months into the year now, and you know, things change, and that certainly looks like it's the case here. Things have changed, and you just got to go with that change. You've got to go with the technical outlook. Okay, everyone, I'm going to start looking as well at, just give me one moment, because those of you who do follow my analysis will also know I like a good Ichimoku cloud, and as you can see here, yep, the bottom of the cloud, the base of the cloud, which is the green line in this chart, 95.40. So we're not going to be too, even just eyeballing that, the chart behind this one, the white one, you can see that 95, you know, 95.40 to 50 is a massive level, and it's also now the base of the daily Ichimoku cloud. The top of that cloud, 97.27. So we're currently kind of, you know, after that. I mean, in fairness, the cloud has narrowed, so it suggests that there's no clear and defined trend going on. But what we have seen is, you know, the base of the Ichimoku cloud is always quite important at 95.40, massive level, massive support level now. And on the upside, obviously, you know, obviously if we do drop as well below kind of 97.20 and stay below there, we currently are just testing around that level. That's also a very short-term bearish development. So do watch out for that. But we have seen we've seen dollar yen come under a lot of pressure, or should we say safe haven flows into the yen, really help prop up this cross. Okay, the next cross that I'm going to look at is going to be euro. Just bear with me there one moment, because obviously we had a really nice move higher, nice push higher after that, after the ECB meeting. We did say it actually on Wednesday. I hate to kind of blow our own trumpets, but there you go. Broke out the top of our range at 132, got all the way to kind of just above 133, but we are running into some resistance there, which is no surprise. Obviously, the whole numbers, we haven't been at this level really since February. So remember that. Do you remember the beginning of February at that ECB meeting? The ECB did kind of slam it down. It got to 137. And then we fell all the way below 130. Well, we range traded for a couple of months, and now it seems like we're in kind of recovery mode, because obviously for us, what will potentially drag this cross lower? Two things. Number one, it would be maybe a less hesitant rhetoric coming out of the Federal Reserve regarding the tapering or the end of QE3. The second thing would obviously be the ECB. They've come in and they've been able to slam euro down. They could potentially do that again. Now, ultimately, we do think the gains in euro dollar are capped. We think they're going to get very nervous around about 134. And we could start getting some ECB members come out and just, casually drop into conversation the fact that that euro dollar is looking a bit overbought, and we could potentially see, or the dollar's looking oversold, euro dollar looking overbought, and we could potentially see some negative deposit rates. Watch out for that. Any rhetoric regarding negative deposit rates could potentially send euro hurtling hurtling south. So, where does this leave us, though? What are the levels that we're looking at? Just bear with me one moment. I'm just going to pull up my other chart. That's what I'm tapping away doing here. So this is the Ichimoku cloud. Just to give you a sense of the fact that, we are now above the cloud. That is a bullish development. As you can see, 133 acting as fairly good support, fairly good resistance, as one would expect. And then really above there, you're looking at kind of 134. Oh, that's not going to work. Oh, no, there's that. Sorry. So we're above, a lot of major resistance levels already. There was that kind of cluster of moving averages. The top of the daily cloud. The further actually we move back towards kind of 130, or move ahead of 133, the more worried I'm going to be just a little bit that we're getting a bit stretched, because we are quite away now from those moving averages. That doesn't necessarily, the market does not listen to technical signals, by the way. It does essentially what it wants to do. But do watch out for that. Obviously 132 is a massive level of support. It was top of that range from April and May. And we, that now turned into very good support. So, in the kind of more shorter term, let's change that to an hourly. As you can see here, having another good go at 133. Whether or not we can get above there isn't too much economic data out of the Eurozone today. Obviously, there is that German court decision on the OMT. Don't get too caught up on that. Basically, they're not going to decide anything, but the Germans do like to kind of have their say on the ECB. Those of you who are German, that's no disrespect there at all, but they do obviously, they're the largest contributors to the bailout fund, so no wonder. But we don't expect any kind of breaking news from there, or any kind of currency-specific news. But what we're really seeing, and it really just goes back to exemplify that point that I said at the start, the commodity currencies are moving one way, and we're seeing euro move completely another. To just exemplify that further, I'm going to show you the Euro-Aussie cross. As you can see, pushing higher. How long ago? It was not that long ago. Just the beginning of this month, we were at 133. We're now nearly 10 big figures, 1,000 pips higher than that. Looking at the daily chart as well, we're making some multi-month moves now in euro dollar, in euro Aussie, multi-year moves. I mean, we're at the highest level now since 2010. We will run in, we could potentially run into some key resistance at 145, and then ahead of that, then kind of around about kind of that 150 level. Whether or not we move higher from here, it will depend on, obviously what the Aussie does, whether or not euro dollar pulls back. We don't have too much, top tier. We have we don't have too much top tier Aussie stuff coming out, so it could potentially be on the euro's back. We have industrial production, and we've got some CPI, which comes out on Friday, I believe, or Thursday. Let me just double check my diary. When is the 14th? The 14th is Friday, yes. So on Friday we get the CPI for May, the final reading. That's going to be quite important. And then next week, obviously, big week. We get some employment. We get more employment data for the first quarter. We get trade balance, and we get the ZEW. So do watch out anyway for data later this week. Tomorrow, again, as I said, industrial production, and then we get CPI on Friday. That could have a bit of an impact, but overall, it seems to be momentum that's pushing this market higher. And it seems to be all revolving around dollar yen. Don't ever really, forget how important that is. Dollar yen, the FX market does tend to like to it almost focuses on one thing at once, and then it impacts everything else. What we do know is that a rising yen has tend to lead to falling commodity currencies. And we can see that. Actually, as I showed you at the very beginning, this is Aussie yen, so falling from its high. And what's quite interesting about this is, sorry, you're going to have to look at these two charts together, but as you can see, Aussie yen exaggerated a very sharp move lower, but it is kind of mirroring what dollar yen is doing. So it's just an exaggerated version. So when we see the yen rise, it really does have a big impact on those commodity currencies. Now, I sent out a note earlier. I know some of you do look at our research on the research page. I'm just going to send you that link yet again. Bear with me one moment. This is my latest piece on Aussie Kiwi. Do take a look. Let me know if you agree with it or not. I kind of felt that Aussie was a little bit, Aussie dollar anyway was looking a little bit obviously oversold, and it has looked oversold for a while. That doesn't necessarily mean that it will stop looking oversold. No, not at all. But we had, it just suggested to me that we were maybe just basing just a little bit, and I felt that rather than look at it against the US dollar, I felt it was probably best against the Kiwi. So as you can see here, it has actually started moving higher. So that was quite a nice little look. There were a couple of things that were positive that drew my eye to it. The first one obviously was this 200-hour moving average, which to me was my first target level, 119.79. Not only was it, Not only is it is also the it's the 200-hour moving average, and it's also the daily pivot. So that was always going to be a key short-term resistance level. But there were a couple of things that really drew me to it. And do watch my do look at that note to get just a sense of just even my thinking, so you can just try and maybe get inside my head and why I was looking at Aussie Kiwi. I was also looking at the spread between Aussie and New Zealand yields, so that was another reason why I was looking at it. So certainly worth looking at that. Okay, the next thing, the other thing I'd just point out to you as well, of course, was this. So it was the hourly MACD, bit of a bullish crossover. I saw that just at the cusp. I was quite lucky. Obviously, I'd been back. I hadn't been back long, but I saw how sharp Aussie dollar had fallen overnight, and it was my first day in the office for a while. So the first thing I look at when Aussie dollar falls so far is Aussie Kiwi. Sometimes it doesn't tell you anything. Just today it did. It gave me this kind of idea, and it suggested to me that maybe we were going to be in for a bit of recovery in Aussie, but the way it was going to recover was, essentially what it meant was that the Kiwi could potentially be playing catch up as another commodity currency that the market seemed to love to hate at the moment. Okay, now I'm happy to take a couple of questions. I've whittled on for a long time, so let me know if you've got a couple of questions, and then I'm happy to answer them. If you've got any questions, do let me know. I might just finish this. Did I look at euro? Oh, we did look at euro, yeah. So let me know if there's anything else you want me to look at. I know there's a lot to digest there. I'll show you just the dollar index as well, because the dollar has come under some pressure. Obviously, largely through dollar yen, but also through some of the other major crosses too. And as you can see there, we're trading in a very tight range, but we really have backed away from those highs. So it suggests that, we're in a bit of a new paradigm now for dollar. If we get below 81 in the dollar index, that's going to be a very, very bearish development, and suggests that this kind of move higher in dollar yen could potentially be ended. But again, watch that. We're not there yet. We're trading in a very tight range between 81 and 82. But we are back within that range. Thoughts on CAD? CAD has been an interesting one because, obviously the dollar has fallen so sharply against the majors, or the top three majors, and that people seem to forget that it's actually doing quite well again. It's not falling on a broad-based basis. It's done quite well against the commodity currencies, and that also includes the CAD. So we're back above 102, bullish development, 102.10, 50-day moving average on the close. Opens the way definitely to this kind of just below 103 now, this kind of top here, which was an intraday high from Friday. Certainly worth watching. Again, looks like we've just made a bit of a bottom at 101.70. And in my view, CAD will come under pressure for as long as the Aussie does. In that sense, I think, the Aussie has been hit first. The Kiwi's coming under pressure. The CAD, there could be a bit of catch up, so we could get to 103 in dollar CAD. So worth watching out for that one. Kevin has asked me about dollar Swissy. Happily look at that. That'll probably be my last one. I don't want to keep you guys too long. As you can see, again, dollar Swissy is kind of moving in the same direction as dollar yen, as it always does. Largely because it is also a safe haven, the Swiss franc is, of course, and as you can see here, broken through some key levels. Obviously, 94 was a massive level, massive support level. Got through there pretty quickly, and also just seemed to be sliding through these moving averages. The fact that we got through kind of 93.5, which is the 200-day moving average, a very bearish development. But right now, 92 is the level of support to watch. Obviously, if we see continued declines in dollar yen, then I think that will infiltrate through to dollar Swissy as well. But there could be some good buying interest, just as I showed you. I do think there could be some good buying interest. Pam said, why Aussie Kiwi instead of Kiwi dollar? The reason why I'm saying Aussie Kiwi rather than Kiwi dollar, as in to go short Kiwi dollar, indeed you could do that, but I'm looking at it more from kind of the Aussie recovery perspective, and that was what my focus was. I think the dollar could be quite volatile today, so I'd rather having due to that, and because I just couldn't get a firm grip on which way it would go, I decided to put the two commodity currencies together. But yes, I mean, in that sense, Kiwi dollar could come under pressure. So could dollar CAD could continue to recover. So there's a good point. But Pan, that was just my thought process. I didn't have too good a handle. Things are moving very, very quickly. I'd been out for a few days. I was a little bit fuzzy. So I decided to look at the two commodity currencies together. Okay, guys, good luck trading today and for the rest of this week. There's a lot going on, hard hats at the ready. Thank you, everybody, for joining. Please do join us next week for more. Also, those of you going to the Shares Magazine conference, I will be there in the morning, I think, doing a couple of things. I think I'm on a panel, and then I think that I'm doing a conference on candles and how you can use them when you're actually trading and using a trading platform. Okay, everyone, thanks so much. Bye-bye.